Welcome to our channel. We are so glad you found your way here. Let us help you fall asleep. Let's begin with the quiet collapse of Washington WaMu, the collapse of the American bank. Take a slow, deep breath in and release it. Even the tallest towers eventually quiet down. Tonight, we gently explore the empty boardrooms and forgotten ambitions of the past. Your mind is calm, and we are ready to begin. The origins of Washington Mutual trace back to 1889, when it was established in Seattle, Washington. Originally known as Washington Mutual Savings Bank, it emerged during a period of rapid growth and development in the Pacific Northwest. The founding principles centered on providing accessible banking solutions to middle-class families, emphasizing service and community engagement. A commitment to consumer lending and savings catalyzed its rise, fostering a sense of trust among its clientele. As the years progressed, it expanded its offerings, embracing innovative mortgage products that catered to a burgeoning housing market. This expansion was characterized by a distinct focus on residential lending, which positioned it as a key player in the financial landscape. The organization adopted a customer-centric approach, aiming not only to attract deposits, but also to assist individuals in achieving homeownership, a cornerstone of the American dream. This institution became synonymous with growth and opportunity, earning a reputation for its straightforward banking practices. However, as it thrived, a contrasting narrative began to emerge within the industry. The rapid expansion created pressure for higher profits, leading to increasingly aggressive lending practices. This shift would later contribute to its vulnerability amidst a changing economic environment, setting the stage for the eventual downfall of this once stalwart institution. The thriving years of Washington Mutual in the 1980s marked a period of aggressive expansion and innovation. This institution, initially founded as a savings and loan association, capitalized on the deregulation of the banking industry. It embraced the emerging market opportunities, allowing it to grow its assets exponentially. Locations proliferated across the Pacific Northwest and beyond, offering a diverse array of financial products that appealed to an increasingly discerning public. During this time, it positioned itself as a customer-focused bank, emphasizing community involvement and accessibility. The introduction of new mortgage products attracted a wave of homebuyers, further solidifying its presence in the residential lending market. Innovative marketing strategies and a commitment to customer service facilitated a bond with consumers, fostering a sense of loyalty that proved essential for growth. In this atmosphere of expansion, Washington Mutual adopted a distinctive corporate identity, differentiating itself from traditional banking competitors. This was a time of optimism and promise, where it seemed poised to redefine the banking landscape. The ethos of the institution resonated with individuals seeking a personal banking experience, leading to an influx of deposits that fueled further lending. As the economy flourished, so too did its influence, culminating in a prominent position within the national banking sector. This trajectory foreshadowed the challenges that would later emerge, as rapid growth often masks underlying vulnerabilities. Expansion strategies defined the essence of this institution in the 1990s. Aggressive acquisitions became a hallmark, with the pursuit of smaller banks marking a significant phase in its growth. This approach not only broadened their market share, but also intensified competition within this region. Each acquisition was framed as a strategic move to harness new customer bases and enhance service offerings. Branch expansion followed suit, with the establishment of new locations across various states. This push for accessibility was accompanied by significant investments in technology and infrastructure, designed to streamline operations and attract clientele. The allure of convenience resonated well with consumers, contributing to the institution's rapid ascendance in the banking hierarchy. Despite the numerous benefits touted by executives, the underlying complexities began to surface. The integration of diverse banking cultures often proved challenging, leading to operational inefficiencies. These new branches, while increasing visibility, also imposed significant costs and management burdens. The ambitious expansion efforts, initially perceived as a pathway to dominance, inadvertently set the stage for vulnerabilities that would become critical in subsequent years. Amidst this relentless drive for growth, the institution's risk management strategies began to falter. As it ventured deeper into new territories, the implications of excessive exposure became increasingly evident, foreshadowing the impending challenges that awaited on the horizon. The initial public offering marked a significant turning point, transforming the once modest institution into a publicly traded entity. Investors welcomed the opportunity, buoyed by the allure of rapid growth and expansion. This surge in interest led to a valuation that exceeded expectations, signaling confidence in the newly minted public company. Shares soared, reflecting a burgeoning belief that it could sustain its trajectory. In this environment of optimism, the institution capitalized on its initial success, aggressively pursuing acquisitions and expanding its footprint. They positioned themselves as a leader in the mortgage market, tapping into the growing demand for homeownership. The allure of seemingly easy profits and an expanding customer base fueled a relentless push for market share. Yet beneath the surface, cracks began to form. The aggressive lending practices and the pursuit of high-risk mortgages would soon reveal the fragility of this newfound success. Financial indicators, though positive in the short term, masked underlying vulnerabilities. The rapid expansion strained resources, and the complexities of managing a larger organization began to surface. While the excitement of the public offering initially masked these issues, the foundation was laid for challenges that would soon become insurmountable. As the institution continued to grow, the weight of its decisions would soon manifest in unforeseen consequences. This shift in strategy marked a significant turning point for the institution. Riskier lending practices gained momentum, with subprime mortgages emerging as a lucrative avenue for profit. These loans, often extended to borrowers with poor credit histories, presented an alluring opportunity to capitalize on a growing demand for housing. The allure of substantial returns overshadowed the inherent risks, leading to an enthusiastic embrace of high-risk lending. In the early 2000s, the market thrived on optimism, with many believing that rising home values would mitigate potential losses. It was during this period that the institution began to aggressively expand its portfolio of subprime loans. Agents and brokers, incentivized by commissions, marketed these products to a wide array of borrowers, often overlooking the long-term implications of such decisions. This region of the financial landscape became increasingly complex as the institution bundled these high-risk mortgages into securities, which were then sold to investors. Confidence in the housing market remained unshakable, yet the foundation of this confidence was precarious. Behind the facade of growth lay a web of vulnerabilities that would eventually unravel. As defaults began to rise, the consequences of these earlier choices became evident. the institution found itself grappling with the ramifications of an expansive, yet flawed lending strategy. The initial euphoria gave way to uncertainty, setting the stage for further decline. Beneath the surface of a burgeoning economy, a housing boom emerged, catalyzing rapid expansion within the financial sector. This phenomenon created an environment where lending practices became increasingly lenient, allowing institutions to extend credit to a broader demographic. With trust in real estate as a solid investment, this region witnessed a surge in mortgage-backed securities, driving profits and encouraging aggressive growth strategies. Institutions engaged in increasingly complex financial products, believing these innovations would insulate against market volatility. The rapid escalation of home prices, coupled with a culture of speculation, fostered a sense of invincibility among lenders. They expanded operations, pursuing new markets and clientele, often neglecting the inherent risks associated with such growth. It became commonplace for institutions to overlook the fundamentals of sound lending, opting instead for short-term gains. The interconnectedness of financial products created a fragile web, where a downturn in one sector threatened systemic stability. The rise in adjustable-rate mortgages and subprime lending further exemplified this reckless abandon, as these practices contributed to a growing disparity between the perceived value of assets and their actual worth. The seeds of disillusionment were sown, leading to a gradual unraveling where the initial optimism would soon be eclipsed by an overwhelming sense of foreboding. The emphasis on retail banking defined Washington Mutual's business model, positioning it as a prominent player within the American financial landscape. This institution sought to cater to everyday consumers, offering a range of services that included savings accounts, personal loans, and mortgages. It cultivated a sense of accessibility, encouraging individuals to trust in its ability to meet their financial needs. The banking branches, adorned with welcoming designs, created an environment of familiarity, a stark contrast to the more austere financial institutions of the time. Expansion efforts were relentless, driven by the belief that capturing market share would solidify its standing. Aggressive marketing strategies and attractive incentives for customers became commonplace. The allure of enticing interest rates on loans and the promise of personalized service drew a steady influx of clients. Yet, this approach relied heavily on volume, exposing it to vulnerabilities that would later manifest. As the financial landscape shifted, the very model that once propelled growth began to falter. The focus on retail banking, though initially fruitful, became a double-edged sword as the economy faced turbulence. An overextension of credit and an increasing number of defaults on loans placed immense pressure on the institution. The seismic shifts in consumer behavior and market dynamics began to erode the foundations of trust that had been so meticulously built. High-profile acquisitions marked a pivotal moment in the narrative of this fading company. The purchase of Fleet Bank in 2001 represented a bold move, expanding its footprint in the Northeast. This acquisition, initially celebrated for its potential to amplify market presence, soon revealed complexities that would reverberate throughout its operations. Integration challenges emerged, stemming from cultural mismatches and operational inefficiencies, sowing seeds of discord within the organization. Confusion reigned as strategic directions shifted under the weight of a larger, more unwieldy structure. The acquisition of Dime Savings Bank followed suit in 2002. This move aimed to enhance market share in New York, a crucial financial hub. Yet this ambition was overshadowed by the mounting pressures of an increasingly competitive landscape. The anticipated synergies failed to materialize, burdening the organization with additional costs and an expanded risk profile. Financial metrics began to reflect the strain of these decisions, as profitability waned and asset quality deteriorated. Regulators scrutinized the institution more closely, heightening anxiety within its ranks. A sense of uncertainty permeated the atmosphere as these once promising acquisitions became emblematic of missed opportunities. Trust dwindled, and the weight of past decisions pressed heavily upon the fragile structure of this once thriving enterprise. Pressure mounted as the competitive landscape shifted. Rivals adapted swiftly to the changing economic environment, positioning themselves as more stable alternatives. The allure of larger institutions, with their fortified reputations and expansive resources, drew customers away from the fading company. Prominent competitors showcased robust risk management strategies, enhancing their resilience during uncertain times. This shift contributed to a growing perception that the fading company could no longer contend effectively in a market increasingly characterized by volatility. Strategic missteps became apparent. While other banks diversified their portfolios and embraced emerging technologies, the fading company clung to outdated methodologies. This reluctance to innovate resulted in a diminished market share. As competitors leveraged their agility to attract tech-savvy customers, it became evident that the fading company was falling behind. The stark contrast in customer experience further exacerbated the decline. The weight of regulatory pressures compounded these issues. Competing institutions navigated the evolving landscape with greater ease, demonstrating compliance and adaptability. Meanwhile, the fading company wrestled with the remnants of its past misjudgments, which restricted its ability to pivot. In this environment, the once prominent banking institution became a shadow of its former self. It struggled to reclaim its position as a leader, left to witness competitors thrive while it grappled with the consequences of its stagnation. Leadership within this institution became increasingly fragmented as the decline accelerated. The board of directors, once a source of innovation and growth, began to resemble a collection of hesitant figures, each grappling with the mounting pressures of an evolving financial landscape. This atmosphere left little room for decisive action. Key figures such as the chief executive officer struggled to navigate the complexities of a rapidly changing market. Their vision, once ambitious, now appeared convoluted and reactive. Decisions that were once made with conviction became mired in indecision, reflecting a profound disconnect between strategy and execution. In this environment, management was characterized by a lack of cohesion. Various departments operated in silos, exacerbating inefficiencies and stifling collaboration. Communication faltered, further alienating teams from a shared purpose. The absence of a unifying vision rendered the leadership ineffective as they attempted to address challenges without a coherent plan. Amid escalating financial pressures, the executive team faced criticism for its handling of risk management practices. Oversight mechanisms proved inadequate, failing to adapt to the complexities of an increasingly volatile market. As accountability waned, the confidence of investors and stakeholders dwindled. The leadership's inability to inspire trust became emblematic of the institution's broader struggles, contributing to its eventual downfall. Lending policies within this institution reflected a profound detachment from prudent financial practices. In an era characterized by aggressive growth, WaMu adopted a strategy that prioritized volume over quality. This approach led to the proliferation of subprime mortgages and questionable lending criteria. The desperation for market share resulted in a dilution of standards, enabling borrowers with insufficient credit histories to secure loans with little to no verification. The consequences of these lending practices became evident as defaults surged. A considerable portion of the mortgage portfolio was composed of high-risk loans, which, in a stable economy, might have been manageable. The combination of falling home prices and rising interest rates exacerbated the situation, leading to an unsustainable spiral of foreclosures. Compounding these issues, internal risk assessments were often superficial or disregarded altogether. Management's focus on short-term profitability overshadowed the importance of sustainable lending practices. The resulting portfolio became a latent liability. In this deteriorating environment, the once robust reputation of WaMu waned. Investors and customers began to lose faith, marking the gradual erosion of confidence in the institution. An examination of these financial practices reveals a crucial misalignment between ambition and responsibility, laying bare the vulnerabilities that contributed to its decline. The use of securitization emerged as a significant factor in the transformation of loans into securities, creating a complex web of financial instruments. This approach allowed financial institutions to bundle various types of loans, such as mortgages, and sell them to investors. It provided an influx of capital, ostensibly strengthening balance sheets and facilitating further lending. With this strategy, risk was dispersed across multiple parties, obscuring the true nature of underlying assets. Amid the booming housing market, this region witnessed a proliferation of risky lending practices. Subprime mortgages became an attractive option for many, as they promised high returns for investors, while the underlying borrowers lacked sufficient creditworthiness. The allure of securitization masked the inherent risks, leading to an environment where unchecked ambition flourished. Consequently, as the housing market began to falter, the facade of security crumbled. The very instruments that were designed to distribute risk began to expose vulnerabilities across the financial system. Investors faced significant losses, prompting a ripple effect throughout the economy. The decline of this once robust institution was marked by an inability to manage the consequences of its own innovations. The fallout from these financial missteps underscored the limitations of a system reliant on securitization without adequate oversight, highlighting the critical need for balance between ambition and accountability. Signs of instability emerged within this fragile landscape, revealing flaws that were often overlooked amidst the fervor of growth. Rising delinquency rates among borrowers began to surface, indicating a shift in the health of the housing market. These indicators, while subtle at first, hinted at deeper vulnerabilities within the financial structures that underpinned economic prosperity. Analysts noted a rise in adjustable-rate mortgages, which exposed borrowers to escalating payments that many could not sustain. The market's appetite for risk intensified as institutions sought to maximize profits by lowering lending standards. With this came an increase in subprime lending, targeting individuals with poor credit histories. The allure of quick returns clouded judgment, leading to a proliferation of risky loans that would eventually contribute to widespread defaults. In this environment, the complexity of financial instruments often masked the underlying risks, creating a false sense of security among investors and regulators alike. A growing chorus of voices began to caution against the unsustainable nature of this expansion. Market analysts and economists issued warnings that went largely unheeded, overshadowed by the prevailing optimism. The interconnectedness of financial entities created a precarious web where the failure of one could set off a chain reaction affecting many. Unbeknownst to most, these early warning signs would soon cascade into a full-blown crisis, disrupting lives and economies across the country. Mismanagement and risk assessment failures within the institution revealed systemic issues that permeated its operations. A culture of aggressive growth overshadowed prudent oversight, leading to decisions that prioritized short-term gains over long-term stability. This approach fostered an environment where risks were underestimated or wholly ignored. The leadership, fixated on market expansion, often overlooked essential risk management protocols, allowing vulnerabilities to linger unnoticed. Internal reports indicated a troubling trend, where employees raised concerns about the quality of loan portfolios and the efficacy of lending practices. These warnings, however, failed to penetrate the upper echelons of management, who remained steadfast in their belief that the market would continue its upward trajectory. This disconnect between frontline employees and decision-makers created a chasm of communication, effectively stifling any proactive measures that could have mitigated emerging risks. The reliance on complex financial instruments compounded these issues as the institution ventured into unfamiliar territory without adequate understanding. Scrutiny of these products was minimal, with oversight mechanisms designed to catch potential pitfalls falling short. As the foundation of the bank eroded, it became increasingly evident that internal governance was insufficient to manage the mounting pressures of an unstable market. The ramifications of these internal failures soon materialized, marking the beginning of a relentless decline. An intricate web of perceptions enveloped the fading company. Credit rating agencies, entrusted with the task of assessing financial stability, played a pivotal role in shaping public confidence. In the years leading up to the collapse, WaMu received ratings that suggested a level of security and reliability, often viewed as a beacon in the banking sector. This false sense of assurance stemmed from a reliance on outdated methodologies that failed to account for the emerging risks within the housing market. Analysts frequently overlooked the burgeoning signs of distress, choosing to focus on quantitative metrics that painted an optimistic picture. The complex financial instruments and subprime mortgages, which were proliferating in this region, went largely unexamined. This oversight fostered an environment where risk was underestimated and the implications of mismanagement were downplayed. WaMu's ratings remained relatively stable, even as the foundation of its operations began to erode. As the housing bubble expanded, the disconnect between the ratings and the company's true financial health widened. Investors, acting on the assurances of these agencies, continued to pour capital into the institution. The ultimate failure of WaMu was not merely a reflection of its internal decisions, but a culmination of external validations that had led many to believe in an illusion of safety. The repercussions of these misjudgments would manifest in ways that rippled through the financial landscape. The passage of the Gramm-Leach-Bliley Act in 1999 marked a pivotal moment for financial institutions. This legislation effectively dismantled the barriers that had separated commercial banking, investment banking, and insurance services. It ushered in an era characterized by increased competition and a rush towards diversification. It invited banks to broaden their services, encouraging them to venture into previously uncharted territories. Firms eagerly embraced this newfound freedom, seeking to capitalize on the potential for greater profits. They expanded their portfolios, often taking on excessive risks in pursuit of higher returns. A culture of rapid growth emerged, driven by the belief that larger institutions would be more resilient in the face of economic challenges. This atmosphere led to a marked shift in operational strategies, as many banks, including Washington Mutual, sought to innovate and attract a wider customer base. Regulatory oversight, once a stabilizing force, began to wane. This reduction in scrutiny created an environment where risky lending practices proliferated. The consequences of this deregulation would soon become apparent as institutions became increasingly vulnerable to market fluctuations. In this region, the foundations that once ensured stability began to erode, setting the stage for a series of failures that would reverberate throughout the industry. Washington Mutual's ambitious expansions, once seen as a hallmark of progress, would soon reveal themselves as harbingers of decline. In the wake of escalating losses, a pervasive sense of uncertainty enveloped the institution. Investors, once eager to support its aggressive growth strategies, began to harbor doubts. Analysts scrutinized financial statements, uncovering alarming discrepancies that hinted at deeper issues. This region, once a beacon of financial optimism, now felt the weight of skepticism creeping in like a dense fog. The decline in confidence manifested in the stock price, which plummeted steadily, reflecting the growing wariness among stakeholders. The once vibrant trading floors became quieter, conversations hushed as whispers of impending doom circulated. It was not just the numbers that troubled observers. The culture within the organization began to shift. Employees sensed the unease, their morale faltering as the reality of possible collapse settled in. In boardrooms, tension mounted as executives grappled with how to mitigate the fallout. Strategies that had once ignited enthusiasm now served as reminders of miscalculation. A cycle of fear emerged. As uncertainty grew, more investors opted to withdraw their support. This withdrawal compounded the challenges already faced, leading to a further erosion of trust. The atmosphere was thick with apprehension, as the realization dawned that the institution's fall from grace was no longer a distant possibility, but an imminent reality. The accumulation of bad loans marked a critical juncture in the institution's trajectory. The loan portfolio, once a source of pride, began to reveal its vulnerabilities. Subprime mortgages proliferated within its holdings, reflecting a risky strategy that prioritized volume over prudence. These financial instruments, initially perceived as opportunities for profit, soon deteriorated into liabilities that weighed heavily on its balance sheet. Analysts scrutinized the underwriting standards that had once defined the institution's reputation. The erosion of these criteria became evident as loans were approved with minimal verification and inflated valuations. Borrowers with shaky credit histories received funding, often with terms that would inevitably lead to default. As delinquencies mounted, the repercussions reverberated through the wider economy, exposing the fragility of the financial landscape. The once vibrant branches now stood as quiet witnesses to this decline. Employees, once filled with optimism, faced mounting pressure as the weight of non-performing loans became increasingly apparent. The implications of these decisions rippled outward, affecting not just the institution, but also the communities it served. A growing awareness of the impending crisis settled over these regions as trust eroded and confidence waned. What began as a calculated expansion turned into a cautionary tale, illuminating the perils of unchecked ambition and the inevitability of consequence. The fading company now faced a reckoning, with its legacy hanging in the balance. The surge of foreclosures marked a significant turning point, exacerbating the already precarious situation. It became increasingly evident that this region was grappling with severe economic distress as home values plummeted and borrowers defaulted on their loans. The rising tide of foreclosures directly impacted the financial health of the institution, revealing deep cracks in its mortgage portfolio. Lending practices, once viewed as aggressive yet profitable, began to betray the institution. It had extended credit to subprime borrowers, believing that rising home prices would mitigate the risk. The reality proved different, as many properties fell into disrepair and neighborhoods became ghostly reminders of a more prosperous time. With each foreclosure, the financial burden grew heavier and reserves dwindled. Investors, once confident in the bank's ability to weather economic storms, began to withdraw their support. The stock price, a reflection of perceived stability, started a downward trajectory that would soon become alarming. Analysts scrutinized the balance sheets, revealing alarming ratios that indicated an inability to cover mounting losses. The institution's reliance on mortgage-backed securities, once a lucrative avenue, turned into a liability. This rapid deterioration fostered an atmosphere of uncertainty. As doubts spread, the once thriving entity became synonymous with failure, leaving a profound impact on the financial landscape. The vacuum of confidence created ripples across Wall Street, where investor relations transformed into a battleground of skepticism. The perception of this failing institution shifted dramatically, from a beacon of prosperity to a cautionary tale. Analysts, once eager to promote its growth potential, began to question its viability. Reports filled with cautionary language emerged, each word serving to erode the fragile trust that remained. As the market reacted to negative sentiments, stock prices plunged, reflecting the growing unease among stakeholders. Investors, once loyal patrons, began to withdraw their support, compounding the entity's struggles. The echoes of diminishing returns reverberated through trading floors as panic selling took hold. Observers noted the swift transition from optimism to despair, a testament to the volatility of market perception. Discussions in boardrooms turned increasingly frantic, striving to craft narratives that could restore faith. Yet, with each failed attempt to reassure, the chasm widened. The motivations behind investment decisions shifted, focusing more on risk aversion than opportunity. This climate of heightened scrutiny made recovery seem increasingly unattainable. Within this environment, the institution's leadership faced an uphill battle against a tide of skepticism that threatened to engulf all remnants of its once esteemed reputation. The lesson learned was one of fragility, where perceptions could dictate the fate of even the most established entities. The dynamics of public sentiment shifted dramatically, revealing a fragile foundation beneath consumer trust. As uncertainty loomed, anxiety began to permeate this region, suffocating confidence in financial institutions. It became evident that even the most storied establishments could crumble under the weight of scrutiny and doubt. The erosion of faith was gradual yet profound, rooted in a growing awareness of risk and vulnerability. Individuals, once loyal patrons, started withdrawing their deposits, seeking safer havens for their assets. This exodus was not merely a reaction to immediate concerns, but rather a broader reflection of a changing mindset. It underscored a collective realization that stability, once taken for granted, was now a fleeting illusion. The bank's once solid reputation began to deteriorate, stripped away by the relentless tide of skepticism. This decline was marked by a series of public relations missteps, further alienating customers. Leadership at the bank struggled to project a sense of security, their reassurances falling on increasingly deaf ears. The gap between perception and reality widened, with each passing day amplifying the sense of distrust. The once bustling branches now stood as echoing ruins, a testament to the fragility of consumer confidence. In this environment, the demise of the institution was inevitable, a quiet surrender to the shifting winds of public opinion. Capital injections were considered a necessary measure to stabilize finances during the institution's decline. Efforts to attract investments were undertaken with great urgency as stakeholders sought to restore confidence. Various financial firms were approached, hopeful that fresh capital could stem the tide of loss and uncertainty. These attempts were marked by a series of negotiations, each more strained than the last, as potential investors weighed the risks involved. The landscape was rife with skepticism. The allure of return on investment was overshadowed by the looming specter of failure. Promises of revitalization were met with hesitance, as the institution's previous mismanagement lingered in the collective consciousness. Investors scrutinized the balance sheets, dissecting the increasingly grim financial forecasts. Despite the institution's efforts to present a facade of resilience, the reality was stark. Each infusion of capital was a temporary reprieve, a brief moment of buoyancy in an otherwise turbulent sea. The influx of funds did not translate into sustainable growth. Instead, it served as a bandage on a wound that was deepening. In this quiet struggle for survival, the institution's fate seemed sealed. The flawed strategies employed did little to address the root causes of its turmoil. The faithful hope for a resurgence was slowly giving way to resignation. The environment shifted as monetary policy evolved under the Federal Reserve's influence. Interest rates, once a tool for growth, began to reflect a stark reality. The institution, tasked with stabilizing the economy, made decisions that would inadvertently contribute to the bank's decline. Low rates, intended to stimulate borrowing and spending, did not yield the anticipated vitality. Instead, they fostered an atmosphere of risk and complacency. In this region, the allure of easy credit blurred the lines between prudent lending and reckless speculation. The bank, caught in this web, expanded its mortgage portfolio aggressively, drawn by the promise of high returns. This approach, while seemingly beneficial in the short term, led to exposure to a burgeoning housing bubble. When the tide began to turn, the repercussions were swift. As the Federal Reserve responded to rising inflation by increasing interest rates, the landscape shifted dramatically. Borrowing costs escalated, causing a ripple effect throughout the financial sector. Customers grappled with mounting debt, and defaults began to rise. The once thriving institution found itself ensnared in a tightening vice, unable to adapt to the new economic environment. The fading company, now burdened by a declining asset quality, faced intense scrutiny. Confidence waned, and the implications of these decisions became increasingly apparent. In this context, the hope for recovery dwindled, leaving behind a stark reminder of fragility in financial systems. The housing boom reached a zenith marked by unprecedented valuations and rampant speculation. This region, characterized by soaring prices, became a landscape of optimism where homeownership was seen as an attainable dream. Developers thrived, and lending institutions eagerly extended credit, often with minimal scrutiny. This exuberance masked the underlying vulnerabilities within the economic framework. As prices escalated, a growing number of individuals entered the market, convinced that appreciation was inevitable. The allure of easy profits led to a surge in risky mortgage products. These decisions, rooted in ambition, veiled the reality of deteriorating lending standards. The peak was met with a collective belief that the boom would persist indefinitely, yet the seeds of decline were sown in this environment of unchecked growth. When the tide began to turn, the initial signs were subtle. Home sales slowed, and defaults started to rise, creating ripples that would soon evolve into profound consequences. Many were unprepared for the abrupt transition from prosperity to decline. Properties that once commanded lofty prices began to languish unsold, their values plummeting. In this chaotic descent, financial institutions faced increasing pressure, with the specter of insolvency looming ever closer. The echoes of the boom faded, revealing the stark complexities of a market that had outpaced itself, leading to an inevitable correction. Quarterly reports began to reflect the unsettling truths that laid beneath the surface. Revenue figures, once robust and promising, exhibited signs of strain as the fiscal quarters passed. Assets, inflated by questionable lending practices, could no longer mask the underlying weaknesses. Loan delinquencies rose, casting shadows over the financial health of the institution. Investors scrutinized these documents with growing concern. The balance sheets unveiled a troubling ratio of non-performing loans to total assets. This region, once vibrant with activity, now echoed with uncertainty. Provisions for loan losses increased, an acknowledgement of the deteriorating credit quality lurking within the portfolio. Earnings per share, once a point of pride, dwindled, drawing attention to the faltering operational efficiency. Each line item told a story of missed opportunities and escalating liabilities. The financial statements, supposed to inspire confidence, instead sowed doubt among stakeholders. The divergence between reported earnings and underlying economic realities widened. Analysts expressed skepticism about the sustainability of profits, questioning the aggressive growth strategies that had been employed. Regulatory scrutiny intensified, as the federal oversight could no longer overlook the discrepancies that lay hidden within the metrics. This gradual unraveling exposed a fragile foundation, culminating in a critical turning point where optimism transitioned into cautious trepidation. The narrative of growth was now overshadowed by the weight of unforeseen consequences. Leadership decisions during the year 2007 began to reveal cracks within the institution. Executives faced mounting pressure to maintain profitability amidst a volatile financial landscape. They opted for aggressive expansion strategies, pursuing risky mortgage products and subprime lending as a means to capture market share. This choice, driven by an urgent desire to boost short-term earnings. In this climate, risk assessment protocols were weakened. An emphasis on immediate results overshadowed prudent financial management, leading to a series of misguided investments. The decision to overlook warning signs was indicative of a broader culture that prioritized growth over caution. Internal assessments, which should have prompted a reevaluation of strategy, went largely ignored. This period was marked by a lack of cohesive communication among leadership. Differing visions resulted in fragmented strategies that failed to align with the company's core principles. As the housing market began its decline, executives remained optimistic, unable to foresee the mounting problems that would soon engulf them. The choices made during this pivotal year not only underscored a profound disconnect between ambition and reality, but also set in motion a series of events that would lead to significant financial distress. The consequences of these decisions would echo through the corridors of the institution for years to come. The impact of the Bear Stearns collapse reverberated throughout the financial landscape, casting long shadows over various institutions, including Washington Mutual. As confidence waned, skepticism regarding financial stability intensified, creating an atmosphere thick with uncertainty. This region, once bustling with activity, now saw cautious investors retreating into shadows, wary of further declines. Declining stock prices reflected the mounting anxiety. The fallout from Bear Stearns catalyzed a broader reassessment of risk, forcing many to scrutinize their exposure to mortgage-backed securities. Washington Mutual, heavily invested in these products, found itself ensnared in this web of distrust. Analysts began to question the viability of its business model, and concerns over liquidity became palpable. The institution faced heightened scrutiny from regulators and the public alike. Depositors, anxious for their savings, withdrew funds, triggering a liquidity crisis that would soon spiral further. Attempts to reassure stakeholders fell flat, as each press release seemed to echo the underlying instability rather than alleviate it. Peer institutions also faltered, revealing the interconnectedness of the financial ecosystem. The relentless decline of confidence left no entity untouched, and Washington Mutual became emblematic of the vulnerabilities that plagued the sector. Amidst this turmoil, the once thriving bank found itself grappling with an identity crisis, battling perceptions that threatened its very existence. The decline of risk management practices became a pivotal aspect of its downfall. In the early years, there was an unwavering confidence in the bank's ability to navigate complex financial landscapes. This confidence, however, gradually morphed into complacency. As the market evolved, it became increasingly apparent that the methodologies employed were not adequately addressing the shifting dynamics of risk. Decisions that once prioritized sound lending principles began to yield to aggressive growth strategies. Loan origination processes, previously steeped in caution, loosened significantly, allowing for the proliferation of subprime mortgages. This shift was met with enthusiasm, yet it laid the groundwork for systemic vulnerabilities. Internally, the culture shifted towards prioritizing short-term gains over long-term stability. Risk assessment teams, once vigilant guardians of financial health, found their warnings increasingly ignored. As indicators of distress emerged, the disconnect between management and frontline risk professionals deepened, creating an environment of miscommunication and oversight. External pressures mounted as well. The financial landscape became more competitive, leading to a relentless push for market share. In this atmosphere, prudent risk management practices were sacrificed at the altar of expansion. The consequences of this erosion would soon become starkly evident, marking a significant turning point in the bank's trajectory. The ramifications of these oversights would resonate throughout the wider financial system. Media coverage played a pivotal role in shaping public perception during the decline of this institution. Reports began to surface, highlighting alarming financial discrepancies and emerging signs of instability. As the situation unfolded, these narratives intensified, framing the bank's struggles in stark terms. Headlines painted a grim picture, influencing the sentiments of depositors and investors alike. Trust, once a cornerstone of its operations, began to erode. Panic spread through the community as stories of potential failures became increasingly prevalent. Customers flocked to branches, concerned about the safety of their savings. This cascade of fear was amplified by round-the-clock news cycles and social media platforms, creating an atmosphere charged with uncertainty. The once stalwart reputation began to crumble under the weight of relentless scrutiny. Analysts dissected every misstep, offering insights that often lacked nuance. These interpretations contributed to a self-fulfilling prophecy, hastening the bank's decline. With each negative report, further withdrawals ensued, leading to liquidity issues that spiraled beyond the bank's control. As confidence waned, it became increasingly clear that the media's portrayal had lasting consequences. In this landscape of fear and speculation, the bank found itself unable to navigate the turbulent waters. The cycle of decline accelerated. Leading to a notable deterioration in stock prices. Initially, the shares of Washington Mutual experienced a steady rise, reflecting a sense of optimism surrounding its growth. As the financial landscape began to shift, particularly in the subprime mortgage sector, this optimism turned fragile. Share prices, once buoyed by a robust presence in the mortgage market, began to reflect the mounting pressures from rising delinquencies and a deteriorating economic backdrop. Investors, initially hesitant, started to adjust their expectations, resulting in gradual but persistent declines. This region, characterized by Wall Street's intricate web of trading, witnessed the erosion of value as the market grappled with uncertainty. Throughout the year 2008, the stock experienced sharp declines, peaking in late September when panic gripped financial markets. It was during this period that WaMu's shares plummeted to historic lows, signaling a loss of confidence among stakeholders. Bank runs ensued as depositors withdrew funds amidst fears of insolvency. The once prominent institution, which had commanded a significant share of the banking sector, saw its market capitalization shrink dramatically. This trajectory, marked by a series of alarming dips, culminated in a final collapse, encapsulating the swift and unforgiving nature of market forces in an era marked by unprecedented financial upheaval. The role of the Federal Deposit Insurance Corporation became increasingly pivotal in the wake of such turmoil. Established to maintain public confidence and stability in the financial system, the FDIC sought to prevent bank failures from spiraling into broader economic crises. Regulatory frameworks evolved, responding to the complex challenges presented by institutions like this one. In the years preceding the decline, oversight mechanisms grew more intricate. They encompassed an array of practices aimed at monitoring risk and ensuring compliance with evolving banking standards. The introduction of stress tests, capital requirements, and adherence to strict lending practices reflected an ongoing effort to safeguard depositors and maintain systemic integrity. These developments unfolded against a backdrop of rising public scrutiny as constituents demanded accountability from financial institutions. Congressional hearings and public discourse highlighted the need for reform, prompting a reevaluation of existing regulations. These changes aim to address the inherent vulnerabilities within the banking sector, particularly in periods of economic instability. As failures mounted, the consequences of lax oversight became starkly visible. Stricter regulations emerged, designed to mitigate risks and bolster the resilience of financial entities. This ongoing evolution of banking oversight revealed the delicate balance between promoting growth and ensuring stability, a challenge that continues to resonate within these ruins of a once thriving institution. Cash reserves served as a critical lifeline for financial institutions, providing necessary liquidity to navigate economic fluctuations. In the case of Washington Mutual, the vulnerability of its liquidity became increasingly pronounced as the housing market began to falter. This institution, once a beacon of innovative lending practices, found itself grappling with an imbalance in its cash reserves. In the years leading up to its decline, the aggressive expansion of mortgage lending strategies generated substantial short-term gains. Yet, as loan defaults mounted, the liquidity position deteriorated. Management responded with measures aimed at bolstering reserves, but such efforts often proved insufficient against the prevailing market conditions. The reliance on volatile sources of funding left it exposed to sudden shifts in investor sentiment. With confidence waning, depositors began to withdraw their funds, further straining liquidity. This cycle of distrust accelerated the bank's downward spiral, rendering it unable to meet its obligations. The inability to maintain adequate cash reserves. The role of government interventions in banking became increasingly pronounced as the situation unfolded. Federal bailouts emerged as a critical response to the widespread instability that enveloped financial institutions. This region, once bustling with assurances of security and prosperity, now bore witness to an unsettling reality where taxpayer funds were utilized to prop up faltering giants. The initial actions taken aimed to restore confidence in the financial system. They sought to reassure depositors, investors, and the broader market that essential services would remain intact. These measures, however, often sparked a complex debate, raising questions about moral hazard and the responsibilities of financial entities. The reliance on public funds became a contentious topic, as many questioned the sustainability of such interventions. In these darkened hallways, institutions that once thrived under the glow of economic growth found themselves at the mercy of government support. The influx of capital provided temporary relief, yet it also revealed the inherent fragility within the banking sector. Each bailout, while intended to stabilize the system, further blurred the lines between private risk and public responsibility. With each passing day, the implications of these interventions echoed through the corridors of finance, shaping not only the immediate landscape, but also the future of regulatory frameworks. The fading company landscape began to resemble a patchwork of uncertainty, where trust remained tenuous at best. The onset of the Lehman Brothers bankruptcy sent profound shockwaves throughout the financial sector, reverberating into the very foundations of institutions like Washington Mutual. This event, marked by its suddenness, stripped the veneer of stability that had cloaked the industry, exposing vulnerabilities that had long been ignored. With the collapse of such a significant player, confidence dwindled, engendering a climate of fear that spread rapidly among banks and consumers alike. Liquidity evaporated almost overnight as institutions tightened their lending standards, retreating into a defensive posture. This shift left numerous borrowers stranded, unable to secure the necessary funds for both personal and business ventures. The once thriving lending environment transformed into a stark landscape of cautious reluctance, where loan approvals dwindled and credit lines were slashed. In this context, Washington Mutual found itself adrift, grappling with a deteriorating financial position. Depositors, sensing instability, began to withdraw their funds en masse, resulting in a further depletion of resources. The ripple effect manifested in plummeting stock prices and mounting pressure from regulators, who struggled to maintain order in a collapsing system. The combination of external economic strain and internal weaknesses culminated in a crisis of confidence, hastening the inevitable decline of the institution. This period marked a decisive turning point, forever altering the trajectory of the American banking industry. The struggling banking sector mirrored the pervasive uncertainties surrounding it. WaMu's collapse became emblematic of broader systemic issues, revealing vulnerabilities across various financial institutions. Contemporaries faced similar pressures, grappling with declining asset values and mounting losses. This region witnessed a striking juxtaposition. While some banks maintained relative stability through prudent risk management and diversified portfolios, others exhibited alarming fragility, much like WaMu. A range of institutions struggled to navigate the tumultuous landscape, each revealing different responses to market challenges. Some banks adopted aggressive lending practices, mirroring WaMu's earlier strategies, only to find themselves ensnared in a web of toxic assets. Others, more conservatively managed, attempted to weather the storm, yet were not immune to the pervasive economic downturn. The tension between these approaches highlighted a critical divide: the reliance on risky growth strategies versus a commitment to sustainability. Regulatory frameworks evolved in response to this crisis, but many institutions were slow to adapt. Compliance became a necessary but burdensome task, often met with resistance. The repercussions of this stagnation rippled throughout the sector, amplifying the challenges faced by banks that were unprepared for an increasingly volatile environment. The aftermath of WaMu's failure served as a grim reminder of the fragility inherent in financial systems, casting a long shadow over institutions both large and small. The decision to delay asset write-downs revealed a troubling lack of transparency within the institution. This choice created an illusion of stability, masking the true health of the bank's financial statements. Such a strategy, while designed to maintain investor confidence. The implications of this decision reached far beyond the confines of WaMu. It served as a stark example for other financial entities, illustrating the consequences of prioritizing short-term appearances over long-term accountability. Analysts began to scrutinize the practices of banks nationwide, prompting a broader discussion on the ethics of financial reporting. The silence surrounding asset write-downs became deafening as external pressures mounted. Ratings agencies adjusted their assessments, reflecting the growing concerns regarding asset quality. Investors, once eager to support the bank, began to withdraw their trust, leading to a slow erosion of market confidence. In this environment, the financial sector faced a pivotal moment. The repercussions of WaMu's decisions influenced regulatory discussions on transparency, fostering a renewed focus on the importance of clear and honest financial reporting in the banking industry. Insider actions became a focal point in the unraveling narrative of this institution. Executives engaged in stock sales, a practice that cast shadows over the ethical landscape of their decisions. As the bank's financial stability waned, these transactions raised questions about the motives behind such maneuvers. While they were legally permissible, the timing and scale of these stock sales appeared opportunistic, further eroding public trust. With declining stock prices, the executives' decisions grew scrutinized. It was not merely about profits. Rather, the implications of their actions reverberated throughout the financial ecosystem. Employees, investors, and customers observed a stark disconnect between the leadership's financial actions and the bank's deteriorating condition. Ethical dilemmas emerged, highlighting the responsibilities of those at the helm during turbulent times. This region became a case study in the complexities of corporate governance. The executives' decisions, viewed through the lens of morality, revealed deeper issues within the corporate culture. The alignment between personal gain and the welfare of the institution became increasingly tenuous. The fallout from these actions contributed to a climate of disillusionment, impacting stakeholder confidence and engendering a sense of betrayal. In the end, the ethical ramifications of these insider actions linger, serving as a cautionary tale in the annals of corporate history. Competitors observed the decline with a mix of apprehension and opportunity. The fallout from the collapse reverberated beyond its immediate confines, casting a shadow over the entire banking sector. Rivals, once overshadowed by its rapid ascent, began to reassess their positions, recognizing both the fragility and volatility of the market. Certain institutions adopted a defensive posture, tightening lending practices and enhancing risk management protocols. This cautious approach reflected a broader awareness of vulnerabilities that had previously gone unexamined. Executives convened emergency meetings, strategizing ways to fortify their own financial standings, while simultaneously monitoring the shifting public sentiment towards the banking industry. Others seized the opportunity to expand their market share, targeting WaMu's former customers with enticing offers and incentives. This aggressive marketing shifted the competitive landscape, as banks sought to capitalize on the instability and insecurity felt by the public. Promotions and campaigns emerged, promising safety and reliability in a climate that had suddenly become fraught with uncertainty. Regulatory bodies, too, began to scrutinize practices across the sector more closely, prompting institutions to adopt more transparent policies. Concerns over systemic risk and consumer trust overshadowed ambitions for growth, leading to a more conservative approach in strategic planning. This period of upheaval marked a significant turning point, reshaping the very foundations of banking practices in this region. The final quarter of 2008 revealed the stark reality of Washington Mutual's financial performance. Losses mounted at an alarming rate, driven by a deteriorating mortgage portfolio that had once been a pillar of strength. They reported net losses exceeding $1 billion during this period, a reflection of widespread defaults and foreclosures that plagued their loans. This bank, once a thriving institution, grappled with the repercussions of aggressive lending practices that had spiraled out of control. Liquidity concerns intensified as deposits dwindled, leading to a rapid erosion of consumer confidence. The flight of capital became increasingly evident, with withdrawals outpacing inflows. In this environment, the bank's stock plummeted, losing 80% of its value in mere months. Analysts noted the implications of this decline, highlighting the unsustainable nature of its business model, which heavily relied on high-risk mortgage securities. Regulatory scrutiny heightened as the Federal Deposit Insurance Corporation noted significant deficiencies in risk management. Efforts to stabilize the situation were met with resistance as management struggled to navigate the increasingly complex financial landscape. The economic backdrop continued to worsen, with the national economy entering a recession. The culmination of these factors set the stage for a historic failure, leading to the eventual collapse of this once prominent institution. A palpable sense of unease permeated the air as the month of September unfolded in 2008. Uncertainty gripped the financial landscape, leaving many customers anxious about the stability of their savings. Lines formed outside branches, with individuals expressing their concerns in hushed tones. This environment fostered panic, and deposits began to dwindle. The gravity of the situation escalated rapidly. Withdrawals surged, each transaction symbolizing a vote of no confidence in the institution's viability. Accounts that once brimmed with trust were now being drained at an alarming rate. Investors observed the unfolding scenario with a mixture of disbelief and apprehension, as the realization set in that this was not merely an isolated event, but an alarming trend. The media played a role in amplifying the anxiety. Reports of the bank's deteriorating financial health fueled widespread speculation, further intensifying the rush to withdraw funds. Customers, driven by fear rather than rationality, flocked to tellers, often leaving empty-handed after their requests for large withdrawals exceeded available cash reserves. Inside the fading company, employees witnessed the erosion of a once stable environment. The atmosphere shifted from one of routine to a desperate scramble for reassurance amidst the growing chaos. Decisions made in the boardroom now echoed in the hearts and minds of the customers, as trust evaporated under the weight of impending failure. Employees found themselves caught in a turbulent environment where uncertainty loomed large. Many had dedicated years to the institution, their commitment now met with anxiety and doubt. Conversations shifted from aspirations and goals to discussions of layoffs and restructuring. The morale within the walls of the fading company diminished, fostering a culture of fear instead of collaboration. Each day, the routine transformed into a silent acknowledgement of the inevitable. Shareholders began to witness their investments dwindle, the once promising returns now replaced by stark losses. Reports of declining stock prices painted a grim picture, leading to calls for accountability. The chorus of discontent grew louder as investors questioned management decisions, seeking clarity amidst the chaos. Trust, once a cornerstone of the financial institution, began to erode, resulting in an exodus of capital. Customers, once loyal, became wary as news of instability spread. The bank's reputation suffered, with many seeking refuge in more secure options. Withdrawals escalated, and the once bustling branches transformed into echoing spaces, where anxiety replaced the usual vibrancy. Relationships that had been cultivated over decades frayed, as the community felt the repercussions of uncertainty. The delicate balance among stakeholders shifted, revealing the interconnectedness of trust, commitment, and the fragility of financial institutions. The auction process unfolded with a sense of inevitability. In this critical phase, valuations were meticulously calculated, shedding light on the diminishing worth of the institution. Various financial analysts assessed the assets, liabilities, and overall market presence of WaMu amidst an environment characterized by increasing skepticism. The assessment included a thorough examination of real estate portfolios, lending practices, and operational efficiencies. Numerous potential buyers emerged, each presenting their own estimations of value. The landscape of interested parties ranged from banking giants to private equity firms, all eager to capitalize on a distressed asset. Amidst the fluctuating figures, an atmosphere of uncertainty permeated the negotiations, reflecting broader economic conditions. This region was marked by a tightening credit market and diminishing consumer confidence, which further influenced the perceived value of the institution. As bids were placed, each proposal revealed the stark reality of what had once been a robust financial entity. Analysts pored over financial statements, scrutinizing every detail in an effort to ascertain worth. This scrutiny culminated in a significant moment in financial history. An air of uncertainty enveloped the banking industry as the value of this institution plummeted, leading to an urgent need for intervention. Amidst the chaos, a decision emerged that would alter the landscape of American banking. The acquisition by J.P. Morgan Chase represented a pivotal merger, marked by urgency rather than exuberance. The agreement, forged under pressure, indicated a clear recognition of the instability that had gripped the sector. As negotiations unfolded, it became evident that the acquiring institution aimed to stabilize the situation, not only for itself, but for the wider financial ecosystem. This merger was not merely a transaction, it was a strategic maneuver to prevent further collapse. In the aftermath, the once prominent bank transformed into a subsidiary, its legacy overshadowed by the narrative of survival. Employees and customers faced a new reality, one where familiar practices and cultures began to dissolve. The merging entities faced the daunting task of integrating systems and managing public perception. In this region of corporate restructuring, the challenges were profound yet methodical. This transition illustrated the intricacies within the financial sector, where decisions carry weighty implications. Existing relationships, established over decades, shifted as priorities realigned. The broader implications of this acquisition echoed throughout the industry, signaling a new era of consolidation. Dissecting the aftermath of this acquisition reveals a complex landscape for J.P. Morgan Chase. Initial projections presented a vision of stability and growth, yet the reality unfolded in stark contrast. This institution, once buoyed by its newfound assets, grappled with the lingering specters of WaMu's troubled legacy. The integration of the bank's vast network was fraught with challenges, as operational inefficiencies surfaced amidst a flurry of restructuring efforts. The resulting financial strain prompted scrutiny from analysts and shareholders alike. Losses associated with bad loans and a weakened mortgage portfolio weighed heavily on the balance sheets. It became evident that the anticipated synergies would take longer to materialize than initially forecasted. The ripple effects extended beyond financial metrics, permeating the cultural fabric of the organization. Employees from both entities struggled to meld disparate values and practices, leading to discontent and uncertainty within the ranks. In the long term, the acquisition forced J.P. Morgan Chase to reassess its risk management strategies. The lessons learned from WaMu's downfall were etched into corporate policy, influencing future lending practices and regulatory compliance. The scars of this episode lingered, serving as a cautionary tale for financial institutions navigating the turbulent waters of rapid expansion. The legacy of this merger remains a pivotal chapter in the chronicles of American banking. Legal repercussions emerged swiftly following the collapse of this institution. Shareholders, feeling the impact of significant financial losses, initiated numerous lawsuits seeking accountability from executives who had overseen the merger and subsequent decline. Allegations ranged from mismanagement to securities fraud as investors attempted to navigate the complexities of the situation. Regulatory bodies closely examined the actions of the bank's leadership, scrutinizing decisions that had been made during the years leading up to the failure. This scrutiny revealed a pattern of risky lending practices and inadequate oversight, contributing to a growing sense of disillusionment within the financial community. The fallout extended beyond the courtroom, prompting discussions around the necessity of reform within the banking sector. Various stakeholders found themselves entangled in legal battles, including former executives and board members. The pursuit of accountability often led to lengthy depositions and investigations, revealing layers of decision-making that had. Amidst this turmoil, the broader public sentiment oscillated between anger and resignation. Trust in the banking system eroded, leaving lasting scars on consumer confidence. In the quiet aftermath, the implications of these legal battles echoed throughout a landscape forever altered by the collapse. The environment shifted dramatically for employees in the wake of this upheaval. Job losses permeated the air, leaving a palpable sense of uncertainty among those who had dedicated years to their roles. A once vibrant corporate culture, characterized by camaraderie and shared success, began to erode under the weight of financial despair. These individuals, who had once walked the halls with pride, now found themselves navigating a maze of anxiety and disillusionment. The layoffs were systematic, affecting thousands as the institution sought to streamline operations in a bid to stabilize. Many employees were left grappling with the sudden loss of income and identity as the company they had known transformed into a shadow of its former self. Those remaining observed a stark shift in morale. The camaraderie that once thrived was replaced by an atmosphere laden with fear and uncertainty. This region, once bustling with meetings and collaborative efforts, became eerily quiet as teams disbanded and enthusiasm waned. Survivors' guilt lingered among those left behind, as they faced the daunting task of rebuilding trust and engagement in an uncertain corporate landscape. The culture, once steeped in optimism and ambition, now reflected a somber reality where the remnants of a bygone era served as a constant reminder of what had been lost. Fading trust permeated the atmosphere as customers began to question the stability of their financial institution. Anxiety settled in, manifesting through whispers of uncertainty that echoed through the once bustling branches. The faces of longtime patrons, now marked by apprehension, illustrated a collective shift. A palpable sense of betrayal lingered. Those who had once proudly associated with the institution now found themselves grappling with the fear of financial insecurity. Account transfers became a common occurrence as individuals sought refuge in the perceived safety of competitors. This migration illustrated a startling shift in loyalty, where many preferred the unfamiliar over the once familiar. People withdrew their assets, seeking not only different institutions, but also a restoration of peace of mind. Each transaction represented a small severing of ties, an acknowledgement of the deterioration of confidence. Branches that had once thrived with bustling activity fell silent, the hum of transactions replaced by an unsettling stillness. Empty waiting areas stood in stark contrast to a vibrant past. Staff members, once hailed as trusted financial advisors, now faced the quiet burden of their clients' disillusionment. The slow unraveling of relationships between the bank and its patrons, once characterized by mutual respect, became a poignant illustration of erosion, marking the final chapters of a storied legacy. Regulatory reforms emerged as a direct response to the collapse, illustrating a broader recognition of systemic vulnerabilities within the banking sector. The fallout from this failure prompted lawmakers to scrutinize existing frameworks, unearthing gaps that had allowed for excessive risk-taking. This region witnessed the establishment of more stringent guidelines designed to enhance the stability of financial institutions. New capital requirements were introduced, compelling banks to maintain higher levels of reserves, a measure intended to absorb potential losses more effectively. The Dodd-Frank Wall Street Reform and Consumer Protection Act became a cornerstone of this movement, reshaping the regulatory landscape. It mandated greater transparency, compelling institutions to disclose their financial health with increased frequency and accuracy. The Consumer Financial Protection Bureau emerged, reflecting a shift toward prioritizing consumer interests in banking practices. This agency aimed to safeguard individuals from predatory lending and ensure fair access to credit. In the years that followed, regulators focused on stress testing large banks to assess their resilience under hypothetical economic downturns. This proactive approach sought to mitigate the risks that had previously led to catastrophic failures. Despite these efforts, the haunting echoes of WaMu lingered, serving as a stark reminder of the precarious balance between profitability and prudence in the banking industry. The careful recalibration of regulatory approaches marked a new chapter, driven by lessons learned from the past. The legacy of Washington Mutual continues to resonate within the banking industry, shaping perceptions and strategies long after its decline. Its once prominent brand symbolized growth and accessibility, appealing to a diverse clientele. This reputation fostered a sense of trust, leading many to view the institution as a pillar of financial stability. Such trust, however, proved fragile as mismanagement and aggressive lending practices came to light, unraveling the very fabric of their brand identity. It served as a cautionary tale, a case study for future banking entities navigating the complexities of consumer relationships and regulatory frameworks. Observations of its trajectory prompted a reevaluation of risk assessment protocols and marketing narratives, emphasizing transparency and ethical lending. The tumultuous rise and fall instigated discussions around brand integrity, creating a ripple effect that spurred changes across the sector. The remnants of its influence linger in the careful crafting of new identities by successor institutions. Efforts to rebuild trust in the banking landscape owe much to the lessons gleaned from Washington Mutual's experiences. This region, once bustling with the vitality of its operations, now stands as a testament to the impermanence of success within a volatile industry. The echoes of its history continue to inform the practices of contemporary banks, underscoring the importance of sustainable growth over unchecked ambition. A closer examination of mortgage practices reveals significant lessons derived from the strategies employed by this institution. The aggressive origination of subprime loans characterized its approach, prioritizing volume over creditworthiness. Decisions often leaned towards short-term gains, neglecting the long-term implications of such a strategy on financial stability. This region, once bustling with the promise of homeownership, now stands as a reminder of the perils associated with lax underwriting standards. The allure of high returns led to a culture where risk was underestimated. Borrowers were often approved for loans without proper assessments of their ability to repay. This lack of diligence contributed to widespread defaults, triggering a ripple effect throughout the financial system. In addition, the reliance on complex financial instruments to manage risk created a false sense of security. The use of mortgage-backed securities obscured the underlying vulnerabilities, making it increasingly difficult to identify potential pitfalls. The rapid expansion of these products. These ruins symbolize the critical need for transparency and prudence in lending practices. It becomes evident that a balanced approach to growth, emphasizing risk management and ethical lending, is essential in safeguarding the financial landscape. The lessons learned from this decline serve as a cautionary tale for institutions seeking sustainable futures. The evolution of digital banking post-collapse reflects a significant shift in the financial landscape. Traditional institutions, once reliant on brick-and-mortar operations, began embracing technology as a means to adapt and thrive. The emergence of online banking platforms allowed customers to engage with their finances in unprecedented ways, utilizing apps and websites that offered convenience and accessibility. This shift signified more than just a change in service delivery. It represented a fundamental rethinking of how banking could operate in a digital-first world. In this environment, financial technology firms, often referred to as fintechs, emerged as key players. They provided innovative solutions tailored to meet the demands of a more tech-savvy consumer base. These entities disrupted established norms, offering peer-to-peer lending, mobile payments, and automated investment services with minimal overhead. The integration of artificial intelligence further enhanced customer service, enabling personalized experiences that traditional banks struggled to match. This transition highlighted the importance of agility in adapting to consumer preferences. Institutions that recognized the necessity of technological integration found themselves better positioned to navigate the complexities of the modern financial landscape. The remnants of the past serve as a reminder that innovation is not merely an option, but an imperative for survival in an increasingly competitive market. The consequences of ignoring this shift can be profound, as evidenced by the decline of once prominent entities. The changing landscape of American banking emerged distinctly in the wake of the collapse of a once iconic institution. This period marked a significant transition, characterized by heightened regulations and a reevaluation of risk management practices. Financial entities began to reassess their strategies, adapting to the evolving expectations of consumers and regulators alike. A noteworthy shift was the rise of digital banking, as technology companies and fintech startups disrupted traditional models. This adaptation led to a reallocation of resources, prioritizing online services and user-friendly platforms over brick-and-mortar presence. Many institutions, previously reliant on physical branches, found themselves navigating an increasingly competitive environment dominated by innovation and convenience. Customer trust, once a hallmark of established banks, eroded for some as they witnessed the fallout from financial mismanagement. New entrants capitalized on this opportunity, offering transparency and personalized services that appealed to a more discerning clientele. The focus began to shift towards customer experience, prompting traditional banks to reevaluate their service offerings and engagement strategies. In this evolving landscape, consolidation became a recurring theme as smaller institutions sought refuge in partnerships and mergers to bolster their market positions. The remnants of the old regime remained, but the foundations were being laid for a future that prioritized agility and resilience in the face of unforeseen challenges. The consequences of this transformation continue to unfold, shaping the trajectory of American banking for years to come. Public sentiment surrounding financial institutions has shifted dramatically since the collapse of Washington Mutual. Trust, once taken for granted, has eroded. The aftermath of the crisis revealed vulnerabilities within the banking system that many had previously overlooked. Customers, once loyal to their banks, now approach them with skepticism, questioning the very foundations of their financial security. In this region, the fallout was palpable. Clients withdrew their savings and sought alternatives, often turning to credit unions or online banking solutions that promised transparency and lower fees. The fear of instability lingered as headlines chronicled the implosion of familiar names. It became apparent that the notion of safety was a fragile illusion. Regulatory changes emerged in response to these events, aiming to restore faith in the banking sector. New protocols were established, yet the damage had already taken root. Many consumers remained wary, often opting for cash transactions over digital ones, reflecting a desire for tangible security. The emotional landscape shifted from blind allegiance to cautious deliberation. This change was not merely a reaction to the crisis. It represented a fundamental reevaluation of the role banks play in everyday life. As trust dwindled, these institutions faced the challenge of rebuilding relationships, a task that would prove to be both complex and critical in the years that followed. The evolution of risk management emerged as a vital response to the failures experienced by institutions like Washington Mutual. Emphasis shifted towards a more robust framework for identifying and mitigating potential threats, driven by the awareness of vulnerabilities that had been previously overlooked. Strategies began to incorporate comprehensive stress testing, designed to evaluate the resilience of financial systems under various adverse scenarios. This method allowed for an analysis of potential impacts that were not merely theoretical, but grounded in real-world conditions. The implementation of stricter regulatory requirements fostered an environment where transparency became paramount. Institutions recognized the necessity of maintaining clear communication with stakeholders, ensuring that risk exposures were understood and monitored continuously. This shift encouraged a culture of accountability, addressing the shortcomings that had led to previous downfalls. Data analytics began to play an increasingly significant role in shaping risk assessments. Sophisticated algorithms and predictive modeling emerged as tools to support decision-making processes, allowing for more informed and timely responses to potential crises. These advancements transformed how risks were perceived and managed. Training programs for employees also evolved, emphasizing the importance of risk awareness at all levels of the organization. Enhanced education and understanding became crucial as institutions sought to cultivate a workforce adept at navigating the complexities of an ever-changing financial landscape. Such measures aimed to fortify the foundations of risk management, ensuring greater stability in the years to come. The lessons gleaned from this region extend beyond the singular narrative of Washington Mutual. Numerous institutions have navigated similar treacherous waters, each unveiling a distinct set of vulnerabilities. The collapse of Lehman Brothers, for instance, exemplified systemic risks embedded within excessive leverage and a lack of transparency. The subsequent fallout reverberated across the financial landscape, prompting an urgent reevaluation of risk assessment practices in banks and investment firms alike. In contrast, the decline of Bear Stearns revealed the perils of over-reliance on short-term funding. Its sudden collapse accentuated the fragility of confidence in the financial sector, leading to a cascade of panic that affected institutions globally. These instances underscore a broader theme of interconnectedness, where the failure of one entity can precipitate turmoil for others. Credit unions and smaller banks have also faced their own crises, often stemming from inadequate regulatory oversight and poor lending practices. Each case serves as a reminder of the importance of robust governance and the need for comprehensive risk management frameworks. The remnants of these failures linger, and the responses have led to stricter regulations and enhanced protocols. They serve not only as cautionary tales, but also as crucial learning opportunities. The ongoing evolution of the banking sector reflects a commitment to prevent the recurrence of history's missteps, fostering a more resilient financial system in the future. Regulatory changes after the crisis sought to instill a sense of security within the banking environment. New measures emerged, driven by the need for enhanced consumer protection. These initiatives aim to restore public trust, which had been severely eroded. Stricter guidelines were established around lending practices, ensuring transparency in transactions. Financial institutions were encouraged to prioritize clarity, providing consumers with comprehensive information regarding terms and conditions. The establishment of the Consumer Financial Protection Bureau represented a significant milestone in this effort. This agency was designed to oversee financial products and services, focusing specifically on safeguarding consumer interests. It implemented regulations to curb predatory lending and promote fair treatment, addressing the vulnerabilities that had contributed to the previous crisis. In addition, banks began to adopt more rigorous risk assessment protocols. This shift indicated a move towards a culture of accountability, where institutions recognized their role in protecting consumers. The implementation of stress tests ensured that banks could withstand economic downturns, reinforcing their stability in the face of uncertainty. These changes led to a gradual transformation within the financial landscape. Consumers became more informed, equipped with the knowledge to navigate complex financial products. As a result, the landscape began to shift towards a more transparent and equitable system, reflecting the lessons learned from past failures. The recovery of the housing market marked a critical turning point in banking operations, reshaping the dynamics of financial institutions. With housing prices gradually stabilizing, confidence among consumers began to resurface, leading to an increase in home sales and mortgage applications. This resurgence prompted banks to reevaluate their lending strategies, fostering a renewed emphasis on responsible underwriting practices. In this evolving environment, institutions began to streamline their operations, focusing on risk management and enhancing their technological capabilities. The integration of advanced data analytics allowed for more precise assessments of borrowers' creditworthiness, effectively shifting the approach to lending. Banks, previously burdened by the weight of bad loans, started to enjoy a more favorable risk profile. Amidst this recovery, regulatory bodies implemented stricter standards to prevent future crises. Compliance became a central focus as banks sought to align their operations with new regulations. This led to an increase in operational costs as institutions invested in compliance teams and systems to navigate the complex regulatory landscape. The revitalized housing market also influenced investor sentiment, with many turning their attention back to mortgage-backed securities. This shift created opportunities for banks to re-enter this lucrative segment, albeit with caution, as they balanced the potential for profit against the lessons learned from past missteps. Financial literacy emerged as a critical focus amidst the growing complexity of banking practices. In this environment, an informed consumer base became increasingly essential to mitigate risks associated with financial products. Institutions recognized that consumers equipped with knowledge could make better decisions, thus fostering a more stable economic landscape. Education initiatives began to proliferate, aiming to empower individuals with the skills needed to navigate this intricate financial world. Programs targeting various demographics sought to bridge the knowledge gap. Workshops, online courses, and community seminars became commonplace, highlighting topics such as budgeting, credit management, and investment strategies. These efforts aim to demystify banking operations and clarify the often opaque processes involved in loans and mortgages. By enhancing understanding, they aim to cultivate more responsible borrowing and spending behaviors. In parallel, awareness of predatory lending practices grew. Consumers began to recognize the signs of harmful financial products, leading to a demand for transparency. This shift prompted banks to reassess their marketing strategies and product offerings, ensuring that they aligned with the newly informed public. The impact of this movement was gradual yet significant. As individuals became more financially literate, the overall demand for responsible banking practices increased. Trust slowly rebuilt itself within communities, laying the groundwork for a more resilient banking environment that could withstand future challenges. Investigative reports emerged with an unyielding focus on the factors leading to the collapse. The media scrutinized the decisions made by leadership, dissecting each financial misstep with precision. Analysts provided detailed accounts of the risky lending practices that had been employed. It became apparent that a culture of unchecked ambition had permeated the institution. Journalists uncovered the complex web of subprime mortgages that had been a cornerstone of their business model. This region witnessed a surge in articles and televised segments that highlighted the consequences of such recklessness. Former employees spoke candidly about the internal pressures to prioritize growth over sustainability. Each report added layers to the narrative, conveying not only the failures, but also the emotional toll on employees and customers alike. As these stories unfolded, a collective sense of disbelief emerged among the public. The long-standing institution transformed into a symbol of failure rather than stability. Editorials questioned regulatory oversights, sparking discussions about accountability and the responsibility of financial entities. The broader implications resonated beyond banking circles, influencing policy debates. In the wake of this turmoil, the media's role in shaping public perception became increasingly evident. Investigative reporting illuminated paths towards understanding, revealing the complexities of an industry grappling with its own fragility. This analysis contributed to a more informed discourse surrounding financial practices and ethics. WaMu stands as a poignant example within academic analysis, offering insights into the intricate dynamics of business failures. The institution's reliance on subprime mortgages and aggressive lending practices painted a picture of reckless ambition. In the context of this region's banking landscape, the rapid expansion of WaMu allowed it to capture a significant market share. However, this growth often overlooked the crucial need for sustainable practices. The examination of its financial statements reveals patterns of over-leverage and inadequate capital reserves, hallmarks of an organization unable to weather economic downturns. The decline unfolded as asset values plummeted, triggering a crisis of confidence among investors and depositors alike. The once bustling branches became relics of a bygone era, their facades fading amidst the quiet streets. This transformation from a booming bank to a failed institution highlights the crucial lesson that growth without prudence can lead to catastrophic results. In analyzing WaMu, scholars and practitioners alike glean valuable lessons on the importance of ethical decision-making and the necessity of caution in financial endeavors, ensuring its legacy serves as a cautionary tale for future generations. The financial crisis extended far beyond the confines of a single institution. Its ripples affected economies worldwide, leaving a profound impact on industries and individuals alike. With the collapse of significant entities, trust in financial systems eroded, leading to a pervasive atmosphere of uncertainty. This region experienced not only a decline in consumer confidence, but also a contraction in lending practices, exacerbating the economic downturn. Financial markets, once bustling with activity, faced unprecedented volatility. Investors retreated to safer assets, while stock indices plummeted, erasing trillions of dollars in wealth. The interconnectedness of global economies became starkly evident. A downturn in one nation swiftly translated into repercussions felt across borders. Countries reliant on exports faced significant challenges as demand dwindled. Government interventions became necessary as policymakers sought to stabilize collapsing economies. This period saw unprecedented measures, including bailouts and aggressive monetary policies, aimed at restoring market stability. Yet, such actions often sparked debates about moral hazard and the long-term implications of state involvement in private enterprise. Amidst these challenges, the human element emerged as a poignant narrative. Families lost homes, jobs vanished, and communities struggled. The broader economic landscape transformed, leaving scars that would take years to heal. This phase served as a reminder of the delicate balance within financial ecosystems and the far-reaching consequences of systemic failures. The aftermath of this failure prompted a wave of consolidation within the banking industry. A sense of urgency swept through financial institutions, compelling them to reevaluate their strategies and risk management protocols. The fallout from this incident became a catalyst for mergers and acquisitions, as companies sought to fortify their positions in a market that had suddenly become more precarious. In this environment, smaller banks struggled to compete, often finding themselves vulnerable to larger, more diversified entities. The allure of stability led many to seek partnerships that promised enhanced security and shared resources. This growing trend signaled a shift towards an oligopolistic landscape, where a handful of firms would dominate the market, reshaping the competitive dynamics of the industry. In this region, the remnants of once thriving institutions began to fade into memory. Local branches shuttered, leaving communities without access to essential financial services. The social implications of these closures began to manifest, with increased unemployment and diminished local economic activity becoming apparent. Stakeholders observed a concerning trend. As the number of banks dwindled, the power dynamics within the sector shifted, impacting lending practices and customer relations. A lasting legacy emerged from this collapse, where the emphasis on size and security overshadowed the principles of accessibility and personal service, altering the banking landscape for years to come. Observations by financial experts indicated a growing unease within the industry. These professionals pointed to warning signs, including the increasing risk appetite of institutions and the proliferation of complex financial products. Analysts highlighted how the relentless pursuit of profit often led to practices that prioritized short-term gains over sustainable growth. Predictions emerged, warning of an impending crisis driven by insufficient regulatory oversight and a culture that increasingly favored innovation at the expense of prudence. Concerns were raised about the reliance on subprime mortgages, which created a fragile foundation for many banks. The nature of these loans, coupled with lax lending standards, created vulnerabilities that would soon be exposed. Experts noted that the interconnectedness of financial institutions meant that the fall of one could trigger a domino effect across the sector. The failure to heed these warnings contributed to a sense of complacency among executives who believed in their own invulnerability. In this environment, the very essence of banking began to shift. Customers found themselves navigating an impersonal landscape, bereft of the trust and relationships that once defined their experiences. The ramifications of these decisions would echo throughout the economy, reshaping not just individual institutions, but the entire financial system, leaving lasting scars on the collective conscience of American banking. The prevailing risk culture within the organization played a pivotal role in its downfall. A lack of accountability permeated the hierarchy, allowing reckless decision-making to flourish unchecked. This environment fostered a sense of complacency among executives who pursued aggressive lending practices without fully grasping the implications. Incentives prioritized short-term profits over long-term stability, creating a chasm between immediate gains and sustainable growth. Team members driven by targets rather than prudence often bypassed essential checks and balances. The absence of a robust risk management framework rendered it vulnerable to external shocks, as employees became increasingly desensitized to potential hazards. Internal communication faltered, leading to an echo chamber of optimism that ignored warning signs from the broader economic landscape. In these corridors of power, the prevailing attitude toward risk was one of denial. Employees at all levels had become conditioned to overlook discrepancies, leading to a culture that rewarded aggressive expansion without due diligence. The consequences of such organizational behavior became painfully evident as the financial crisis unfolded. The implosion of this institution was not merely a result of external factors. It represented a failure of corporate governance and ethical responsibility. The lessons learned from this decline resonate deeply, serving as a cautionary tale about the importance of cultivating a resilient and vigilant risk culture within financial institutions. Philanthropic initiatives often serve as a reflection of a corporation's values and priorities. Washington Mutual engaged actively in community support, providing funding for various educational and housing programs. This commitment to corporate social responsibility formed a significant part of its public image. Various partnerships with nonprofit organizations sought to enhance the community's well-being, emphasizing financial literacy and economic empowerment. Despite these efforts, the ultimate impact of its philanthropy was overshadowed by subsequent financial challenges. The disconnect between corporate social initiatives and the underlying instability within the institution prompted questions about the sincerity and effectiveness of such programs. Beneficiaries of its community projects faced uncertainty as the bank's financial health deteriorated. This philanthropic facade created a complex narrative where community support could not mask the impending collapse. While Washington Mutual's charitable contributions aimed to foster goodwill, the systemic issues within the institution undermined these efforts. As financial difficulties escalated, the sustainability of its programs became at risk. Communities that once benefited from its initiatives found themselves grappling with the fallout of a failing institution. In the end, the disparity between its philanthropic aspirations and operational realities highlights a crucial aspect of corporate responsibility, illustrating that true commitment to community welfare extends beyond mere financial contributions. The erosion of consumer confidence marked a significant shift in the banking landscape. Fear began to permeate the collective psyche, resulting in an atmosphere thick with mistrust. This sentiment was not unfounded. Experiences of sudden closures and unseen financial instability left an indelible mark on the community. As institutions faltered, the once reassuring presence of banks transformed into a source of anxiety. Withdrawal rates surged as customers sought to safeguard their savings. Many turned to cash transactions, retreating from an increasingly unstable financial system. This left institutions grappling with liquidity issues, further exacerbating the cycle of fear. A pervasive sense of vulnerability took hold, with individuals questioning the very foundations of their financial security. The intimate relationship between consumers and their banks deteriorated, leading to a growing sense of isolation. Within this environment, marketing efforts failed to resonate. Promises of stability and trustworthiness fell flat against the prevailing backdrop of uncertainty. Consumers preferred to reallocate their resources, often opting for non-traditional financial services. The implications of this shift extended beyond mere transaction volumes. It represented a fundamental change in consumer behavior. As institutions struggled to regain their footing, the gulf between banking entities and the communities they served widened. This environment of fear and mistrust would linger, shaping consumer decisions for years to come. The series of events leading to the decline began subtly, with whispers of financial instability stirring through the industry. In the early years of the new millennium, a rapid expansion marked the beginning of Washington Mutual's aggressive strategy. They prioritized subprime lending, resulting in an influx of risky mortgage products that soon became the foundation of their portfolio. By 2005, early warning signs emerged. Defaults on these loans increased, and analysts began to express concerns about the sustainability of their practices. Share prices, once robust, began a gradual descent as investors grew wary. In 2007, the situation intensified. A significant shift in the housing market took place, characterized by plummeting home values. The burgeoning crisis in mortgages exposed the bank's vulnerabilities, prompting a series of downgrades by credit rating agencies. By 2008, the atmosphere shifted dramatically. The government's intervention in financial markets did little to stabilize the situation for WaMu. A series of losses led to an alarming liquidity crisis, causing panic among depositors. On September 25, 2008, the inevitable conclusion arrived. The Federal Deposit Insurance Corporation intervened, seizing the failing institution and selling its assets to J.P. Morgan Chase. The once thriving entity, now a cautionary tale, reflected the fragility of trust in the banking system. Exploration of alternative banking models offers insights into the shifting landscape of financial institutions. The decline of the fading company highlights the necessity for adaptability in an environment marked by volatility. Innovative approaches, such as community banking and credit unions, present viable options for fostering stability. These models emphasize local engagement, creating relationships that prioritize trust and transparency over sheer profit. In this region, smaller entities often exhibit resilience, built on a foundation of solid customer service and personalized financial solutions. The growing trend towards fintech partnerships reflects a shift in consumer preferences, with technology-driven services catering to a digitally savvy clientele. Such advancements can mitigate some of the risks evidenced by the collapse of traditional banks. Lessons drawn from the demise of the entity underline the significance of prudent risk management. Financial institutions that prioritize sustainable lending practices are more likely to navigate economic downturns without succumbing to systemic failures. Diversification of services and products also emerges as a key strategy, ensuring that institutions can adapt to changing market demands. Regulatory frameworks are evolving in response to these lessons, aiming to prevent future crises. The focus now rests on fostering a more resilient banking sector. The legacy of this once prominent bank serves as both a warning and a guide for new and existing financial players, emphasizing the indispensable need for integrity and innovation. Emerging from the remnants of this historical collapse, the future of American banking appears shaped by a cautious optimism. Institutions now recognize that the integrity of operations must intertwine with technological advancement to thrive in an increasingly competitive landscape. Innovations in digital banking have already begun to redefine customer interactions, paving a path toward a more accessible financial system. Shifts toward transparency and ethical practices are becoming paramount. This region, once dominated by aggressive lending and questionable financial products, now witnesses a slow transformation. Consumers are more informed and demand accountability, prompting banks to adopt clearer communication strategies. The rise of fintech companies introduces an additional layer of complexity. These agile entities leverage technology to provide services that traditional banks struggle to match. As a result, established institutions are compelled to rethink their business models, integrating new technologies while maintaining a commitment to customer trust. Regulatory changes are also anticipated as policymakers respond to past failures by introducing stricter compliance measures. This evolution aims to enhance the stability of the banking sector and prevent the recurrence of crises reminiscent of WaMu's downfall. With these factors converging, the landscape of American banking is poised for a transformative era, characterized by resilience, accountability, and a more profound connection to the communities they serve. The events surrounding Washington Mutual's demise provide stark lessons for the financial sector. This instance of failure underscores the critical importance of prudent risk management. Decisions made in boardrooms often ripple through entire communities, influencing the financial health of countless individuals. Misjudgments regarding risk exposure can lead to catastrophic outcomes, as evidenced by this decline. Institutional complacency played a significant role in this saga. The once thriving entity grew overconfident in its strategies and market position, neglecting the shifts occurring within the economic environment. This over-reliance on an unsustainable growth model. Additionally, the role of regulatory oversight cannot be understated. An evolving financial landscape demands vigilance and adaptability from governing bodies. The lessons learned from this period highlight the need for a robust regulatory framework capable of addressing emerging risks. A commitment to transparency and ethical practices is essential for rebuilding trust within the banking sector. Lastly, the importance of fostering strong community ties is evident. Organizations must prioritize their relationships with the populations they serve, ensuring that their strategies align with the needs and values of those communities. In reflecting on this decline, it becomes clear that the future of banking hinges on these foundational principles.